Okay, good afternoon. Thank you for joining us for this inaugural Rensselaer Global Game Changers online panel discussion presented by the Greater New York Executive Council. The impact of COVID-19 on the financial market, investment insights, and strategies for the new normal. This afternoon, we have more than 250 of you registered for this exciting panel discussion as the first of the Rensselaer Global Game Changers panel series. These webinars are high-profile thought leadership panel discussions presented by regional executive councils in key geographic regions, including New England, New York City, and Silicon Valley. Each panel will feature a topic of emerging global importance with alumni and alumnae leaders in business, innovation, and intellectual discovery and entrepreneurship. Sessions focusing on healthcare and biotechnology and advanced manufacturing and the supply chain will be following. More details will be shared at the end of the seminar. A few housekeeping items before we begin. Please make sure your volume is turned all the way up. You will be muted throughout the presentation out of respect to our presenters. You will see there is a Q&A feature at the bottom of your screen. Please feel free to type in your questions and we will get to them as time allows during the Q&A portion of the program. I am now pleased to introduce Mr. Roy Davis, class of 1978. He is the co-chair of the Rensselaer Greater New York Executive Council and trustee at Rensselaer Polytechnic Institute. He's former president of Johnson & Johnson Development Company and former corporate vice president of business development of Johnson & Johnson. Please welcome Mr. Davis.
Well, thank you. Thank you very much for the introduction. I'm really delighted to be here and want to thank everyone for attending and joining us today. I'm pleased to announce that Dr. Shirley Ann Jackson, president of Rensselaer Polytechnic Institute, is on the webinar today as an attendee, along with fellow trustee of the Institute, Nancy Mueller, and trustee Curtis Preem, class of 1982. Curtis is also secretary of the board, as well as Catherine Murtaugh, class of 1987, who in addition to being trustee, joins us as a panelist this afternoon. As mentioned, the Rensselaer Global Game Changers online webinars are the virtual version of these meetings that we've been having over the last several years. They involve panel discussions on timely topics that are of interest and are presented by these executive councils in various portions of the country, where engaged alumni and alumnae and parents who are innovators, senior executives, and venture capitalists are involved or in attendance. These regional networks and executive councils have been created to strengthen the connections between Rensselaer and its alumni and alumnae. Today's conversation is presented by the Greater New York Executive Council, where nearly 40,000 alumni, alumnae, and parents call home. I would now like to introduce the moderator for today's session, Dr. Thomas Schofi, who is an assistant professor of finance and accounting at Rensselaer Polytechnic Institute. Before his current role, he was co-founder of Microcaps and a senior analyst focused on the technology, media, and telecom, or TMT sector. Tom's research interests include corporate credit markets, including and financial analyst behavior, and his research has been featured in journals including Financial Management, the Journal of Banking and Finance, the Journal of Small Business Management, and Managerial Finance, as well as presented at a variety of annual meetings for finance and accounting associations. Please welcome Dr. Schofi.
Thank you, Mr. Davis. I appreciate that introduction. I'm very excited to be moderating this conversation along with our two exceptional panelists who are both alumni of the university. I'd first like to introduce Ms. Catherine Murtaugh, Esquire, class of 1987, who is co-chair of the Rensselaer New England Executive Council, a recently appointed trustee at RPI, and chief compliance officer and managing director for sustainable investing at Harvard Management Company, a subsidiary of Harvard University. In this capacity, Ms. Murtaugh is responsible for regulatory and legal matters relating to HMC's investment activities, and for designing and implementing HMC's sustainable investing program across all asset classes. Ms. Murtaugh developed HMC's first sustainable investing policy and worked closely with Harvard University in its decision to become the first U.S. endowment signatory of the United Nations-supported Principles for Responsible Investment. Our second panelist is Mr. John Lonsky, class of 1973, who is Chief Economist and Managing Director at Moody's Investors Service, where he is responsible for the analysis of financial markets. A member of the blue chip panel of economic forecasters, Mr. Lonsky participates in a number of other forecasting surveys, among which are the outlooks of the Wall Street Journal, Bloomberg, and the Philadelphia Federal Reserve Survey of Professional Forecasters. Mr. Lonsky has won several awards for forecasting accuracy, including 2014's Lawrence R. Klein Award from Blue Chip Economic Indicators as a top forecaster. I welcome both of you, and I thank you for sparing your time to have this conversation with us. So, given Mr. Lonsky's expertise, and I think a question that a lot of our attendees are wanting to ask is, what type of economic recovery should we expect to see coming out of this crisis? We've had this idea that it could be V-shaped, very quick, U-shaped, L-shaped. I've heard swoosh-shaped. I'd like to hear your expertise on this issue, Mr. Lonsky.
Okay, Tom, first of all, I'd like to thank RPI for this wonderful opportunity to address our audience here and talking about the shape of the economic recovery. One thing we don't want to lose sight of is that this recession is very much the consequence of COVID-19. It is a consequence of a forced shutdown of business activity brought on by a national health emergency. By no means is this current recession like any other recession we have had since who knows when. To give you some idea of what I'm talking about, stop and think that as recently as February 2020, the unemployment rate dropped to a 50-year low of 3.5%. 50 years ago, by the way, was when I started at RPI back in the fall of 1969. And suddenly, 2 months later, by April 2020, where is the unemployment rate? It is at an 80-year high of 14.7%. So this recession is like no other. And as a result, there's a great deal of uncertainty surrounding where the recovery is headed, what form the recovery may take. I'll tell you how unusual the current situation is. When economists are surveyed, you get a wider dispersion of forecasts for over the next several quarters as opposed to over the next several years. Usually it's the opposite. The more we look into the future, the more disagreement there is about where the economy is headed. Not so today. And I want to add to this is that, we have just gone through first quarter earnings seasons. And when the member companies of the S&P 500 are surveyed, what we find out is that 64% of the S&P 500 member companies have dropped earnings guidance for 2020 for the simple fact they have no idea as to what to expect. In some industries, for instance, consumer discretionary industries, that would be motor vehicles, restaurants, airlines, and the like, 97% of those companies have dropped guidance because they are so unsure as to what lies ahead. One thing I could state with some confidence is that if we're only going to have a partial and staggered gradual reopening of the U.S. economy, then what you're going to find is it will be impossible to have a V-shaped recovery. I think the only way you can have a V-shaped recovery is to suddenly get rid of COVID-19 related risks. That might be through a vaccine that suddenly appears. Other than that, maybe at best what you do, you have a U-shaped recovery, a swoosh-shaped recovery. And since we're from RPI, let me throw out some numbers. People love numbers from that school. Okay, what's the real GDP economic growth forecast for 2020? I think we're going to have the U.S. economy shrink by 6% annually. worst annual performance by the US economy since the 1930s. However, things ought to get better in 2021. We should see growth of 4%. That's provided that COVID-19 related risks are adequately contained. And by 2022, maybe a growth slows down, but to a respectable 2.5%. According to this growth forecast, we will not return to where GDP peaked in the final quarter of 2019 until perhaps the second half of 2022.
Wow, that's really great. I personally am finding it really difficult to become an epidemiologist during this economic crisis, because I feel like a lot of economists are trying to do that, and we can only speak to the economic indicators and the confidence issue, not so much to the virology and the science behind the disease spreading. Ms. Murtaugh, do you have anything else you'd like to add from the economic standpoint?
No, I think that's a really great perspective. And again, the fact that this is really caused by a global pandemic beyond pure economic issues, I think is really important to keep in mind when we talk about recovery from this recession.
I agree. So my next question is for you, Ms. Murtaugh. This is about the divergence between the economic conditions and high unemployment, and a lot of the things that Mr. Lansky mentioned, and market prices, which the equity markets seem to be very buoyant. Fixed income markets have been very resilient. How should we think about this divergence across various asset classes? And then how should we think about it in terms of liquidity for a portfolio?
Sure. Well, there certainly is just a tremendous divergence between what you see as the true economic realities and market prices. It's really hard to reconcile a sustained equity rally in the face of 14% unemployment and people standing in line at food bank. There's just a real disconnect there. And certainly some asset classes and some sectors have been hurt very, very hard by COVID. You look at travel, hospitality, leisure. Marriott International just announced with its recent earnings reporting that COVID-19 has had a more sustained impact on their business than 9/11 and the global financial crisis of 2008 combined. So it's just a crazy impact. And I think that a lot of companies, if they really develop a long-term outlook on the sustainability of their business models, we really haven't begun to see the overall impact of COVID that COVID is going to have on the economy going forward. And you're already seeing that with companies moving furloughed workers to laid-off workers, really reconsidering their own growth models and their own feasibility going forward.
Yeah, I agree. I think there's a lot of idiosyncratic risk that facing different industries in different ways. We've seen tech leadership in the market up until today, actually, as people are thinking that we're going to have more virtual work, and a lot of these tech companies are really going to benefit from that trend. Mr. Lansky, what would you like to add from the asset class standpoint in this divergence?
Well, I'm with Kate there. The outlook is very uncertain. It's not very pretty. So you have to scratch your head and wonder why in the world the equity market is up by 35% from its low of March 23rd. Moreover, we're looking at a lot more credit rating downgrades and upgrades. I've never seen this before. I've never seen so many companies put under a negative outlook for corporate credit quality. That being said, the junk bond spreads, not that long ago in late March, the average junk bond yield was 11 percentage points above the corresponding treasury yield. That difference now has gone down to 6.5 percentage points, despite the fact that we see far more downgrades and upgrades in high yield. And we're also expecting a rising default rate for high yield, now at 5.4%. Our analysts at Moody's believe it's going to be approximately, say, 13% by early next year. What's going on? One thing that perhaps is happening that's giving the equity market some support would be the expectation of a long-lasting stay by very low benchmark interest rates. Here I'm talking about the federal funds rate. In all likelihood, the federal funds rate will not be hiked until the second half of 2022 at the earliest. So we'll have a 0% short-term interest rate in effect for some time. Add to that, there's a lot of talk that for the first time since the Second World War, the Federal Reserve is going to put a cap on Treasury bond yields. Here the focus has been on the 3 or 5 year yield. And of course, if that's the case, then we might be looking at a return from the, say, 2 to 5 year Treasury yield, not much greater than 0.5% going forward. Well, if that's all you can get from, let's say, a 5 year Treasury yield, 0.5%, and right now you have a dividend yield just over 2% from the S&P 500, that makes equities look more attractive. Another factor, this has been overlooked by the media for the most part, in the financial press, and that is we've had quite a surge in liquidity. I think earlier you made some reference to liquidity. Here we're talking about the availability of money at a relatively low cost. Believe it or not, right now we are looking at the fastest rate of growth for M1, that measure of the money supply, and M2 on record. If there was any truth to monetary theory as presented by Milton Friedman, this economy might do surprisingly well in 2021. 25% growth for the money supply is unheard of historically. Then maybe that's a positive development. And with this rapid growth of the money supply, we've had quite an increase in the annual rate of growth for business debt. Business loans at banks in the month of April, I believe, were up by more than 25% from a year ago. That's another unprecedented rate of growth for that particular measure of liquidity. In the corporate bond market, we are looking at record-breaking numbers for the issuance of investment-grade corporate bonds. And what is a sharp break from previous recessions, high-yield bond issuance has done much better than expected. Not too long ago, I went to my CEO and CFO and I said, the high-yield bond issuance, boy, that's going to get clobbered. Man, was I ever wrong. Luckily, I was wrong in a way where the company, I guess, benefits were not worse off. I thought it would be approaching a zero. Instead, it's moving along at a pace recently of about $30 billion per month. In a world of infinite liquidity, you will not have any bankruptcies. And I suppose for the time being, the equity market is crossing its fingers and hoping that the Fed can work its magic. And with this unprecedented surge in liquidity, the worst will be avoided. And they're also hoping that if there's going to be a second wave of COVID-19, we are going to be better capable of coping with it than we were with the first wave.
That's interesting. Standard & Poor's, I think today, said that there are almost 1,300 issues that are being reviewed for downgrade right now. So in all this ample liquidity, there are still a lot of credit risk out there that perhaps the market isn't pricing. It also will be interesting to see what's going to happen with inflationary pressures given this increase in the money supply. During the financial crisis, we saw lots of money printing, but we didn't see that spike in inflation that a lot of people had predicted. And now perhaps we will. It'd be interesting to see. That brings me to the next question, which I think is very much related. You touched on it. We've seen this big change in monetary policy, and we've seen a lot of activity in fiscal policy. How can we expect that to influence the markets going forward? And I'll allow Kate to add to this first.
Sure. Well, the Fed has certainly been pulling out all the tools in the toolbox. Certainly, as John already mentioned, we're already in a near zero interest rate environment. And then looking to stabilize the financial markets, the Fed did a lot of what looks like quantitative easing in terms of just massive amounts of Treasury and mortgage-backed securities being purchased and vastly expanding the scope of its repo operations, not only in terms of the amounts that are being offered, but in terms of the length of time on those loans. And even loosening policies to make sure that banks are even encouraged to dip into their regulatory capital and their liquidity buffers to increase lending into the economy. And in a significant step beyond their traditional mandate of the financial markets. The Fed is even helping corporations directly, these highly rated US corps, the so-called fallen angels, where the Fed is doing direct lending, it's buying new bond issuances, it's buying existing corporate bonds, and even purchasing ETFs that are invested in investment grade corporate securities. In terms of consumers, they've kind of increased the TALF program. So, unlike 2008, which really felt much like a liquidity crisis, COVID really feels much more like it's a solvency crisis. And I think that's why you're seeing such massive, massive actions by the Fed in this area.
Just quickly, do you expect there to be an additional fiscal stimulus package soon?
It'll be interesting to see what we can get through Congress these days.
Sure. I did hear that the Senate Majority Leader said that they probably need to do something soon, but there's still some conflict about whether or not some of the benefits are actually encouraging people not to return to work, even though the environment might be safe for work. So that's going to be something interesting to pay attention to. John, what would you like to add to that?
Well, what I could add is that I believe there's going to be more fiscal stimulus. One of the problems with the current stimulus programs would be that they seem to be doing more to help large corporations as opposed to providing badly needed and timely assistance to smaller businesses, to Main Street type businesses. And that could really create a very bad solvency bankruptcy problem fairly soon for the U.S. economy if too many of these small businesses go belly up, fail to reopen, and thus those jobs that are associated with these businesses fail to return. That's got to be worrisome to policymakers. Regarding inflation, I want to add something. There's something very distinctive about this recession compared to perhaps any economic downturn since the Great Depression. And that is, we are seeing a typically large number of people that are still working that are being forced to take pay cuts. And I think that's been especially true for managerial positions, executive positions. I've never seen this in any recession that I can recall since I've been following this data in the early 1970s. If we're taking pay cuts, and that's telling me that even with all this monetary stimulus and fiscal stimulus, the upside for the underlying rate of inflation will be quite limited. Ask yourself, how much longer can the United States get away with having a budget deficit between 15 and 20% of GDP? It had been at 5% of GDP. You want to put a dollar sign on it. We had $1 trillion budget deficit expected for fiscal 2020. I think that deficit will now go up to at least $3.25 trillion for fiscal 2020, and a little bit smaller perhaps next year, moving down to trillion. Not good. And moreover, we're seeing a publicly traded treasury debt soar from what had been an already high 78% of GDP. It will soon at 100%. But let's not forget what happened in World War II. Second World War, we had the budget deficit peak at 30% of GDP. I don't think we're going there. And we also had publicly traded treasury debt peak at 120% of GDP. We're not there yet. Moreover, Japan has had even higher ratios, and the Japanese economy has yet to collapse. Final note, begin to worry about what's going on in Washington with deficit spending and with the rapid growth of the money supply once the dollar exchange rate begins to tank, once we have a lot of dollar exchange rate depreciation. Thus far, the opposite's been true. The dollar has been relatively strong. That is a very good sign. And I think in order to maintain the relative strength of the dollar, you're going to see the Federal Reserve refuse to resort to the same negative interest rate policies that you have elsewhere in the world.
The Federal Reserve has said that they're not going to do that, but they may change their tune if the economic conditions continue to get worse. Incidentally, we did see additional fiscal policy in Europe today, I think in the neighborhood of $750 billion, and it was more of a unified approach And I think the euro sold off on that. So it'll be interesting to see the currency effects as we see this incredible deficit spending increase with this crisis. Okay, great. I'd like to remind our audience that if you have any questions, please feel free to type them in the Q&A section. I'm monitoring these questions and we'll be happy to ask some of our panelists at the end. The last question from the economic standpoint really just has to do with the regulatory environment and the political climate that comes out of this crisis. And I'll give you some leeway on this, whether it be financial regulation or climate regulation, public health regulation. How do you see that evolving? Kate, we'll start with you.
Sure. I think what I've been struck most by in this crisis is that the power of a rapid collective response to a global crisis. And while no one government or one economic actor can solve the COVID crisis individually, everyone seems to be, everyone seems to have recognized that every economic actor has to do its part in this crisis. And I'm really hoping that we can bring that sense of urgency into the future as we tackle, slower moving but no less urgent crises such as climate risk. And we touched on this a little bit earlier about people restating their reissuing their guidance for earnings. I really hope that from a corporate perspective, COVID is really forcing corporations to look at their long-term sustainability and getting away from that short-termism of the constant focus on quarterly earnings to really thinking deeply about what the true long-term planning for the sustainability of their businesses are. And that includes everything from the human capital to supply chain management, and even to the company's physical footprint. And I think that trend is really going to have to continue for companies to be successful in whatever the new normal looks like post-COVID.
So can I ask you a related question? The president and some people have suggested that because we have so much short-termism, that we should move to a semi-annual reporting system as opposed to a quarterly reporting system that we have. Do you think that's a good idea? Would it reduce short-termism?
I think that it definitely would reduce short-termism, and this might just be the push that we need to get beyond that, because I think companies are really now forced to focus on their long-term sustainability. And the markets haven't fallen apart because people have had to move earnings. So this might be an opportunity to really rethink that from a regulatory perspective.
Interesting. John, what would you like to add?
Well, I agree with Kate. It would be better to have semi-annual reporting, but unfortunately, investors strong appetite for as much data as possible. I mean, if we go to semi-annual reporting, then we're going to have to come up with other ways, maybe proxies, trying to figure out how companies might be performing. So, it's hard to move away from quarterly reporting. Now, when I look at, what happened, I can't help but recall, since I was relatively close to ground zero of the financial crisis, the problems we had with mortgages, mortgage-backed securities, and what followed from the financial crisis was a badly needed increase in regulation of the financial services industry and the banking industry, if you like. So my takeaway from this public health emergency would be that there is going to be a clamor for tighter regulation of public health related risks. And the only way this is going to work, the only way it's going to be effective, if it is global in its approach, if it's international in its approach. After all, this virus did not originate in the United States. It came to us from overseas. And I can't help but think, major campaign issue. We're going to be pushing politicians to try to set up international boards of inspectors who will give us an early warning of a possible pandemic whenever that should arise. Globalization is going to be approached much differently when it comes to making sure that we have access to essential commodities, essential pharmaceutical ingredients. You might see new legislation of that sort. Companies will be limited as far as their ability to outsource production of what are deemed to be critical materials.
That's great. Thank you. Thank you for these wonderful answers to these interesting times that we're going through. The last question that I have, and I have some other questions that I will ask later if we don't get more Q&A from the audience. But I want to find out about how Rensselaer has influenced your professional and personal progression, and maybe you can give some guidance to any prospective students we have listening or any alumni we have listening who want to reach the same levels of success that you guys have. Kate, would you like to start?
Sure. I think that probably the greatest skills that I learned at RPI were problem solving and critical thinking. And that as a first generation college student and a resident of Troy, I was very fortunate to have RPI in my backyard, so to speak. So having the ability to stop and think and to look at a problem from all sides before you decide how to tackle it has served me really well as an attorney. And also, I found intellectually, RPI really pushes you beyond what you think you're capable of. And that has given me the confidence to expand my career beyond traditional law practice in areas such as sustainable investing. And to any students at RPI right now, it's always a little scary when you have your first kind of financial correction to happen when you're in college or coming out of college. But just use this and seize any opportunity that you can. And to all the young women who are following my footsteps at RPI, just be fearless and fierce and follow Dr. Jackson's example and just get a seat at the table and make yourself successful.
That's great. John?
Yeah, when I'm starting out, I'm thinking of where did I have an advantage vis-a-vis my peers? And I think it would be, as Kate said, it's in problem solving. You're not afraid of data. You're not afraid to go out there and try to frame a problem in a manner that is understandable. And that was very important and very helpful. I think it was also helpful in that I had a better grasp of what I was doing in terms of economics, in terms of financial analysis, that it wasn't a science in the same way that physics or chemistry or some of these engineering courses might be considered to be a science. And that maybe gave me more flexibility in my thinking. I have friends, let's say, from the other side of the mountain from Troy, Williams College. To this fellow, economics is a science. It's almost like physics, or reality, it isn't. It's actually far from it because of inherent problems we have with predictability in the area of economics. And lastly, RPI was helpful because it gave me an appreciation of how important technology is to giving shape to the economy and to the society at large. And I think we lose sight of that sometimes. We think about fiscal policy and monetary policy, but in the end, what it comes down to is that if we cannot make progress technologically speaking, chances are that we're not going to grow productivity, as they call it in economics. We're not going to grow labor productivity by enough so that we're able to realize a higher standard of living. You know, so much for the stuff about money supply driving the economy in the long run. I don't think so. I think what drives the economy, what drives our well-being in the long run is what becomes of technology.
I agree. I think innovation is one of the core drivers in the financial industry right now with fintech, and I think RPI is a great place to kind of learn that because it combines the technology side with also the behavioral side and identifying market needs and understanding that people aren't always rational actors. Thank you very much. And I'm, as a professor, I'm consistently impressed with the quality of the students at RPI, as well as the alumni and their tremendous success. So I truly appreciate your time today. I'd like to encourage the audience to ask questions. I'm not seeing a lot of questions in the Q&A right now, which is a little bit disappointing, but I do have a question for both of you while I encourage the audience to ask some more questions. With this COVID-19 pandemic, we've seen people working from home. We're working from home right now. A lot of people have suggested that this could lead to a structural transformation in the commercial real estate market as an investable asset class and the prices that are commanded. What do you think about that, both from a consumer standpoint of commercial real estate and potentially as an investor in the asset class? Do either of you like to answer quick?
Sure. I think that is really, people are really rethinking their physical footprint. If you look at some of the restrictions, we have been thinking about in terms of our own physical space with the restrictions that we have in place now in Massachusetts. It would be unthinkable for people to bring their entire workforce back into their currently configured commercial office space. Even think about simple things like restrictions on people's, how many people you can put in an elevator at the same time when you're trying to fill a high rise in lower Manhattan. And many businesses have already come out, even in the financial services sector, saying that they might be reducing their physical footprint by as much as 30%, because they just don't need that space with people being able to function well from home. And another area in real estate, putting commercial real estate aside, there's significant instability now with rent stabilized housing in terms of rent, people not paying rent, and the landlords not being relief given to tenants in terms of not paying rent and eviction holds, but no relief being given to landlords in terms of paying property taxes. So I think there are significant impacts to it across the space.
Yeah, urban commercial real estate, I think, is going to go through a period of stress. There's going to be pressure placed on valuations. This may extend beyond office properties, also to residential properties in densely populated cities. You know, that being said, there's a little bit of good news I should have mentioned early on, and that is mortgage applications for the purchase of a home rose for a sixth consecutive week as of the week ended May 22nd. We've gone from a 35% year-over-year plunge by home buyer mortgage applications back in early April. And now, as of May 22nd, that's up by 8% from a year ago. That's good news. The housing will help restore some vitality to this sagging economy. Office space is probably going to be smaller. We may just occasionally visit offices for those of us that are still going to be working. That raises another interesting point that I'm thinking about. You know, I'm from the class of '73. I'm not exactly the youngest guy around where I work. And I do work in New York City, and the office is in Lower Manhattan, the World Trade Center. And of course, I'm hesitant, to get back on the New York City subway system in order to get to work because of that risk of COVID-19. Now, I say this because at this point in time, workers aged at least 55 years of age, at least 55 years, constitute a record, I think it's 23.5% of employment. Not that long ago, 10 years ago, that share was about 15 or 16%. It's been rising over time. We have people working longer. Like 65 doesn't really mean you're going to retire anymore.
I think John might have just frozen. Yeah, okay, he did.
Compelled to leave.
Okay, thank you. We lost you for a second there, but I appreciate those comments. Really, really good things to think about for the commercial real estate market. I apologize. I have two windows, a Q&A window and an all window, and I'm seeing some more questions in the all window. One of the questions from the Q&A that I think is interesting that we talked about before was this idea, and I've spoken about this with my colleagues as well. With the Federal Reserve buying non-investment grade credits through exchange-traded funds, aren't they essentially just picking winners and losers by saying, okay, you're a member of this ETF, so now all of a sudden we're going to be supporting your credit? And is that something we really should be seeing? Are they going to be creating a lot of moral hazard for some of these companies just because they're members of an exchange-traded fund for their credits?
Want me to go ahead?
Sure.
Okay, fine. I would say, well, an ETF, of course, you don't really know what you're buying into. It could be a high yield ETF. You may not always have knowledge of exactly which high yield bonds that high yield ETF is holding. It's sort of like a mutual fund. And in that, the Fed may be purchasing into the high yield bond market somewhat blindly without any knowledge of who exactly belong to that particular ETF, who's included. Moral hazard, this comes up all the time. This came up during the financial crisis. I think given the special nature of this recession, that it was forced upon us, imposed upon us by a national health emergency, gives the Federal Reserve a little bit more leeway at purchasing high yield bonds indirectly through an ETF. I think the most important factor right now is to limit the forthcoming increase in business bankruptcies or bond defaults for the purpose of allowing companies to normalize operations as quickly as possible. This isn't the time to ask whether or not the person's been smoking in bed whose house is on fire. Rather, put the fire out first and then ask later as to whether or not they had been responsible for that calamity.
Kate, would you like to add something to that?
No, I think that was perfect.
Okay, great. So I'm getting a lot of questions about specific investment advice, and I really don't like to ask those questions and put people on the spot. But I think one of the questions I had relates to the commercial real estate market. This may affect real estate prices in New York. It may affect real estate prices in Chicago, LA, San Francisco, etc. And for municipalities like those in Illinois and those in New York that are facing big deficits and potentially losing a lot of revenue, is it possible, given what the Senate Majority Leader said about what he wants these states to do, that we could see a very large municipal default if this crisis continues?
Kate, you go ahead.
I'll let you take it, John.
Okay, I'll go ahead. And I think that would be a big mistake to have a large-scale municipal default, or worse yet, a state government defaulting on its outstanding obligations. I think what McConnell was trying to say is, listen, if you want to get financial assistance from the federal government because of a fiscal emergency, then there has to be some strings attached. That is, we'll go ahead, Washington will supply you the money, but you have to agree to allow some committee of overseers in Washington to study your budget to make sure that you're doing more to balance your budget. And when I say this, of course, you're going to say, well, let's do the same thing for private corporations. And to a degree, we are. Some of the airlines that have received help are being told that they maybe have to limit executive compensation. They have to limit shareholder compensation in terms of their ability to increase dividends or buy back equity shares. The second you take help from the federal government, you have to expect that the federal government is going to tell you how to go about running your affairs.
It's going to be interesting to see how that evolves. Do you have anything to add, Kate?
No.
Okay. I'm trying to go through some of these questions and get ones that aren't, do you think that you should be more in equities or should be more in fixed income? I'd like to ask a question about other things that you see potentially transforming from this work at home phenomenon that we've seen. There's some people asking about how it might transform education because that relates to RPI. But let's think about more from the business world. What other changes do you expect to see? It could be air travel, it could be hotels, etc. I'm just curious to hear your thoughts on that.
Sure. I think from our perspective, we're primarily externally managed at the Harvard Endowment, and the work from home model has really changed how we think about the diligence that we're doing for our external managers, where it was often done with face-to-face meetings where people would be on airplanes, all the time. Now you're seeing that that has to be done virtually, and it's making a very, very big difference. But we're still able to complete that work. I think we're also seeing a lot of stress on young families in terms of their ability to manage. They suddenly become they have their career, and now they have they're teaching from home, and they don't have childcare, and not having that support available is something that we really need to think about in terms of how we're managing our human capital going forward.
My mother's actually watching my son right now because my wife is also in a meeting. So I completely understand that, because it has effects on the labor market as well. You can't find childcare in this type of environment, or you're concerned about the health effects. It's going to have an effect on people's productivity for sure. John?
Yeah, I'd like to add that I think working remotely works to the disadvantage of younger entrants into the workforce, recent hires. My goodness, I think the most important thing in the world for a newly hired employee is to walk around that office and get to know who's been there, find a mentor, learn how to do your job, form some sort of personal bond with this person if you want to move ahead in that organization. If we all end up working remotely too much, it holds back the development of younger workers. And that could be, one of these unforeseen costs of shrinking the office space, of working too much at a distance from one another.
So thank you very much. That's great answers. I want to shift back to RPI and students. This is the third recession that I've lived through as an adult, and I've had issues when I was looking for a job coming out of undergraduate. What kind of advice can you give students who are looking for a job or looking for an internship in this type of environment when companies are so uncertain?
Okay, I can remember back in the early 1970s, we had a couple of recessions, 1970 and then another one in 74, 75. And as I recall, I had fraternity brothers who had solid GPAs. One guy was an electrical engineer. He had to take his first job at Radio Shack. So he stayed at Radio Shack for a while, but eventually became very successful as an electrical engineer and made out very well. So it could be that a recession's going on. You may not necessarily get that position that you desire, but the important thing is that you don't give up. You keep at it. You keep looking for new jobs, and eventually economic recovery appears. And believe it or not, economic recoveries are much more common than recessions. And with that recovery, you can advance your career at a very rapid rate. Much in the same way you talk about the equity market, bonds versus equities. Well, you look back at it historically, you're going to find that on 80% of the time, equities will increase on a year-to-year basis. I mean, the trick is not to buy when equities are about to go into a deep slump. If you have an investment horizon of 10 or 20 years, well, you should be weighted more heavily towards equities. You should, be avoiding bonds. It's the same principle. Recessions are not forever. Recoveries do happen. And without COVID-19, that record long recovery we had that ended in February of this year would still be going on. Instead of looking at an unemployment rate of maybe 20%, we would have been looking at an unemployment rate of less than 3.5%. Don't give up.
Yeah, it's funny because I'm getting all these requests for individual sectors and stocks and speaking about the Chinese. I don't want to go into that, but I think it is important to say for young people, you should own more of your portfolio in equities because you have a lot of human capital ahead of you, and you should transition more into fixed income as you get older, just based on that asset allocation strategy. Kate, I'm sorry, would you like to add something to that?
I think that John's point is really important. I mean, I graduated from law school in '89 and started in 1990 when a lot of law firms were laying off at least a third of their incoming first-year classes. So I had some very, very talented classmates from law school who had jobs at very high-profile firms that found out they didn't have a job when they showed up for the first day of work. And people had to get really creative in terms of what they thought about doing and just, you know, paying the bills and getting the job lined up. And I think it's so important to use your networks. And I think it's really important for young people to reach out, you know, through their parents' networks, through any other adult that they have a lot of respect for in terms of where they are in their own career. And really, I think that it's when jobs are easy to come by, people kind of let that slide sometimes. I think it's really important to develop that skill of really being able to network effectively and to build those relationships early in your career, because at some point you're going to be you're going to be in the position where you can help somebody. And so most people, I find, are more than willing to reach out and help younger people when they need that now.
It is a little more difficult to network when you can't do it in person, but I do encourage students to get on LinkedIn and go to events virtually and try and connect with people that way. Okay, I think we only have a couple minutes left, but I want to get your perspective, Kate, on something, because we got John's economic expertise at the beginning. If we do see a lot of defaults in the energy sector, and we've seen some, and we might see more, like Chesapeake is supposedly thinking about a bankruptcy filing, how does that change our outlook for sustainable energy? Will it lead to more growth? Will it potentially lead to too much supply in the traditional energy sector? I'm just curious how you think about that.
I think what you're seeing now in the energy sector is really a shortage of storage. If you just they can't be pumping at the rates that they were because they're not selling the reserves. I'm really hopeful that the COVID crisis and the impact on oil pricing will help to really get people to focus on renewables and to move towards a more sustainable view. And the Harvard Endowment has just made a commitment to become net zero GHG emissions by 2050 in the endowment. So we're already thinking about ways that we can be carbon footprinting our investment portfolio and then moving towards a decarbonization strategy to be aligned with the Paris Accord.
That's great. I'm sure that the students and the faculty there are really proud of that, and I hope we see similar initiatives at other universities. Okay, I think we're pretty close to the allotted time, and I really just want to thank you both for your valuable time and for your incredible advice to RPI alumni and students. I think it's wonderful. And I want to thank everyone for attending. I apologize I couldn't get to everybody's questions, but I really don't feel comfortable asking a panelist, hey, which stock would you buy? Because it's just not the kind of question you generally see in these forums. If you want to have somebody comment randomly about stocks, I recommend you put on Jim Cramer on CNBC. That's what his job is. It's not the job of professionals like this. Okay, so I'll leave this to I'll say thank you to everybody and allow our VOG to wrap up.
Great, thank you, Professor Shofi, and thank you to our panelists and for everybody who's attended today, and to Mr. Davis for the introductions today. Everybody here will be receiving an email within the next 24 hours to ask you for feedback on a survey. So be sure to check your email. Also, we do have a couple other panels coming up in June. One is the Rensselaer New England Executive Council presents the impact of COVID-19 on healthcare and biotechnology. And on June 24th, the Rensselaer Silicon Valley Executive Council presents the impact of COVID-19 on current and future consumer expectations. Also, save the date, we're doing Giving Day, 2 RPI Giving Day on June 28th, a virtual event where you can support students, and be sure to check your email for more details, and also support Rensselaer. We have a new research fund, as well as our annual fund and a student relief fund. If you can go to giving.rpi.edu for more information on that. Thank you, everybody, again. Please stay safe and healthy and have a great afternoon.